Hey, what's going on, everybody? Welcome back to the Land Development Podcast. I'm your host, Ryan Glick. If this is your first time joining us, each week when you tune in, you will hear one of two different types of shows. Sometimes when you tune in, you're going to hear an interview style show where we have on someone associated with the land development industry. We hear about their origin story, and then we dig into some topics that are of interest to them. Other times when you tune in, you are going to hear industry news. That's where we pull up a few different headlines and we talk about what those headlines and the articles and everything mean for the land development industry. And joining me, as always, on these industry news episodes is Charles Covey. Charles, how's it going?
It's going good. How are you?
Pretty good. You know, one thing that happened as I was preparing for today's show is I was thinking I haven't gone and looked at our ratings and reviews on any of the podcasting platforms lately. So I took a quick peek out there and I came across this one. So for those of you who are listening in and can't see this, let me just read this to you really quick. And this one was posted on January 1st of 2025. And the reason this is important is because it's our first non-5-star rating and review that we've received. So the headline of this reads, Politics. And the message says, not everyone in this industry is a Trump supporter, so keep the politics out of it. This actually made me laugh a little bit because it shows how polarizing politics is, and not just politics, but Trump in general.
Right.
And I think it's important for anybody listening into the show to know that, I think we all know, at least most of us know, that politics plays a huge role at the federal, state, and local level when it comes to real estate and land development. And I think for anybody listening in to think that we're not going to talk about politics, especially on these industry news episodes, that's just not going to happen. I mean, we're going to talk about it, how it impacts the industry. We're going to talk about our opinions on it, which may mean that those of you listening in might disagree with where we stand on certain things. And that's fine. Like, we should be able to disagree with each other on certain things. So I wanted to point this out because we're not going to stop talking about politics. We're not going to stop talking about our personal opinions on what we think is going to happen or what we think should happen. And anyway, I also wanted to say, too, with this out there, now that our perfect 5-star rating is ruined, I'm going to say that for all of you listening in right now, we have a lot of people listening in every week and a lot of new people listening in. And we only have 15 ratings and I think 4 actual reviews on Apple. And then on Spotify, I think it's like 10 ratings. So there's a lot of you out there that have not left us a rating and review yet. So I'm just asking you if you would do us a favor and hit the pause button and go over to whether you're on Apple Podcasts or Spotify or wherever you're at and leave us a rating and review. I think it will only take like 2 minutes. Tell us what you're enjoying about the show. Would really appreciate it because at least maybe we can get our 4.8 up to a 4.9 and try to keep it there at that spot. But anyway, seriously, if you all would do that, it would mean the world to us because it does help with the algorithm on Apple and Spotify. The higher that rating and review and the more recent the ratings and reviews, the more people who are searching for land development content, podcasts and everything, they'll be shown our show as an option. So again, it goes a long way in helping us. We're going to continue to produce the show. We're going to continue to record these episodes for all of you. So if you could do that for us, it would mean a lot to us. So
yeah, if you great Americans would go do those reviews and not let this one liberal review drag us down. So
yes, please. All right. With that said, let's go ahead and move on and get into the topics for today. Our first article that we have comes to us from Fox Business. Headline reads, Real Estate Expert Says the Housing Crisis Can Be Solved. So this one is actually a video from Fox Business. So I'm going to pull up the video here. We'll listen to the video or watch if you're on YouTube watching us, and then we will react to it. So here we go.
Trump is on the world stage today. He is demanding that interest rates drop immediately. Housing affordability, a big issue for Americans. Our next guest says 3 things need to happen to unleash housing. Let's get to billionaire real estate investor Larry Conner. Larry, you heard President Trump today, and one of the things that he talked about in that virtual appearance at Davos was talking about lifting regulations on domestic projects that are at least $1 billion or more. That maybe doesn't help a lot of, downstream, real estate projects. Certainly, a building in LA, maybe $500 million. But it seems to me that he is basically telling us, look, the EPA is going to get out of the way, and that the regulatory framework for housing, for building, whether it's commercial or residential, is going to be open. We are open for business.
Yeah, Cheryl, thanks for having me, one. And two, yes, you're absolutely correct. The reality is, across America, we have an affordable housing problem, in some cases crisis. You can solve it. I think the Trump administration is uniquely qualified to do so, and here's how you do it. One, common sense regulations. You can't have 30 or 40% of your total cost in permits and red tape. Two, create at the federal level low interest rate loans, 3 or 4% versus 7. The economics have to work. 3, tax credits. You do all those, you'll unleash the full power of the free enterprise system.
But here's the thing with the interest rates. That's the Federal Reserve. That is Jerome Powell. He was just appearing with those bank CEOs. He could tell Jamie Dimon, he could tell Brian Moynihan, I need you to offer loans at 3 and 4%. And those bank CEOs are going to say no.
I think you actually, Cheryl, it's a good question, but I think you actually have a better vehicle. Fannie, Freddie, and HUD, which is under the direct control of the federal government. And they were established to do exactly these kinds of things. And because of President Trump's and others' background, they're knowledgeable about these type of things. Right now, the issue is the economics don't work. You can't ask a developer to spend $70 million building this affordable housing, and when they finish, it's worth $65 million. By the way, I would clearly say you have to put tight regulations around these developers, both in terms of the quality of the build and the quality of how they maintain them.
Let me ask you about what we're seeing once again in California. Wildfires are once again raging with the Santa Ana winds, and this is the story that we've been covering for a couple of weeks now. What is your overall take and what type of situation we're going to be in the Los Angeles area? President Trump plans to go tomorrow to look at the damage. That is a story that seems to be, not giving us clear visions of how the rebuilding efforts are going to happen in a state that, again, going back to regulation, it is state regulation, not federal regulation, that has hurt these projects in California.
That's a great, timely question. Here's the problem and here's the opportunity. The problem is, in fact, there was a recent research study just completed of residential projects. 30% of the total cost is permits and red tape. And it can take up to 4 years just to get them approved. The opportunity is for the state of California to rectify that. I think it'd be great if the current administration and the federal government puts pressure on them, because the reality is that's a real disaster, but it's one that all Americans got to come together to fix.
What kind of projects are you yourself looking at right now? What's in the immediate future for you?
Yeah, so we don't do apartment development. We buy existing apartment communities, and we think the Midwest is way underrated. Now, we operate in 18 cities all around the country, as far west as Phoenix, Denver, and then in the south, Tampa, Charlotte, Atlanta. But we like those cities, but we think the Midwest has tremendous opportunities.
Interesting. Larry Connor, it's always great to see you and speak with you, Larry. Thank you for being here.
All right, so there's a few different things that were covered there in that video. Number one was his 3 steps for what he thinks the federal government should do, what the Trump administration should do related to lowering regulations. I'm not sure what percentage of those regulations are federal versus, state and local. So that's one thing. The next thing he mentioned was lowering low interest loans from the federal government, specifically through Fannie, Freddie, and HUD is what he said. And then the last thing was tax credits. Based on those what he said there. What are your thoughts, Charles, on his what he said?
Yeah, the whole system is designed to work in a way where it is state and locally regulated. Like, we kind of want to keep that, right? We don't want the federal government to start being in here, in an overarching manner with a lot of regulation, because in an administration that wasn't positive, now that control could be a pretty negative scenario. So we still have to keep state and local as the primary driver. But the huge thing with interest rates, in theory, that could be an enormous boon to development. The challenge, though, is that getting the project to the point of financing, there's a lot of stuff that has to happen before that interest rate even matters. And that's the real thing he's talking about this 30% entitlement and development costs. And that's a real number. And that there's, in some cases, might be even higher than that, because you think about all of the risk that us developers take on and how we have to make dollars through the process, and how we have to stack in what seems like, oh my God, you're going to make that much money on that one deal. Well, yeah, but we had to do 10 other deals that never could come to fruition, and we had to pay for all of that. So we got to recoup all of that in this one. And so that's the nature of the beast, and it's not efficient. It's wildly inefficient. So yes, that is a huge element. Pull that 30% of development cost out of the project and make things go. Yes, it would completely change the way that things are developed, and it would drive housing costs down for sure, guaranteed. But it's a lot of words, and I don't know exactly how they're going to enact that. It's a very complex, challenging system. And again, the federal government doesn't have a ton of control over that. So they can request that things get changed, but it is a hard thing for them to regulate from DC.
Yeah, that was one of my thoughts, listening to this, was that he had mentioned the lowering regulations. And then when they got to the California wildfire rebuild, he specifically mentioned that the costs at the state level in California are, 30% are related to red tape, but it's state level, issues. So I'm not sure how the federal government, other than trying to pressure, but I agree with what you're saying. I don't think we want the federal government to get into the business to have even more impact, because I think we quickly forget that once you give somebody power, you're not always going to have the person in office that is going to do what you want them to do. And when they have that power, it may go in the opposite direction of what you want them to do. I think we need to get more of this in the hands of the people and keep it at the state level. But, states that are wanting to do business, you'll have more people and opportunities in those states. And the states that want to have more regulations, you're going to have less opportunity and less, they're not going to flourish as much as other states are.
Well, you've got the federal government has an ability. They can pull all 50 governors, get them all in a room, and Trump can say, hey, we're gonna withhold funding on infrastructure projects and all these other dollars that the federal government drives to states. We're going to withhold all that funding if you don't do what we need to do. And that's a very Trump-esque way to negotiate, and it's pretty damn effective. So that is a situation that would be, you put a housing czar in place. They put this meeting together. Trump shows up. They deliver their pitch of, hey, you do what we need and you drive housing costs down, or we're not going to play nice. And that would be pretty effective. Is that the long-term best situation for the country? I don't know. Maybe, maybe not. But it would work. So there is a path. There is a way that the federal government can, because they control so many dollars that go to different states. They do have a lot of power. So I don't want to underplay the fact that yes, it's supposed to be a state-regulated thing, but there is that federal ability to make things happen if they need to, and kind of twist arms if necessary. And then that would depend on the governors to go back to their states and say, okay, state legislature, we have got to fix these things. Here's what we need to do. And that housing czar could give them the playbook of kind of how legally to go about doing it and what bills need to be passed. So again, it is very possible. We'll see what happens. We got 4 years and it could happen.
Yep. And we've seen, through the first few days in office, there's been a lot of stuff happening. And so not a lot with respect to these topics here. There are some in the third article we'll get to here in just a little bit. But let's go ahead and move on to the next article here. This one comes to us from Globe Street, and the headline reads, SFR rents 20% higher than multifamily rents. So reading from this article, single-family rentals are fueling rent growth across the country as homeownership remains challenging due to significant upfront costs and unpredictable mortgage rates. The asking rent for a typical single-family home was $2,174 in December, according to Zillow data. That's up 4.4% from last year and 40.6% over the past 5 years. By comparison, multifamily rents grew just 2.4% from last year and 26.2% over the past 5 years, according to Zillow's data. As of December, single-family rents were 20% higher than multifamily rents, which is the greatest disparity between these two subsets since Zillow began tracking this data in 2018, the report said. SFR rents fell on a monthly basis in 20 major metro areas in December. The largest monthly decrease in SFR rents were in Salt Lake City, Boston, Buffalo, Denver, and Virginia Beach. Despite this performance, SFR rents rose year to year, December in all of the 50 largest metro areas, led by Hartford, Connecticut, St. Louis, Cleveland, Chicago, and Indianapolis. High vacancy rates and pricing pressure in the apartment market, driven by a glut of new units, are impacting single-family rents, according to a recent Rentometer rental report. Vacancy rates for single-family rentals reached 6% during the third quarter, the highest they have been since early 2018, the report said. Rentometer pegged the average single-family rent at $2,357. As we enter 2025, it's fair to say that concessions in the multifamily market are here to stay, said Zillow. Whether single-family rent growth will continue to rise at a rapid pace ultimately depends on where mortgage rates go. But with limited construction of single-family rentals on the horizon, this segment of the market will likely stay tight. So what are your thoughts on this, Charles, and kind of where we're at with single-family rentals versus multifamily?
Yeah, this is the world that I live in every day as we develop our BTR subdivisions. And this is a huge element. So a lot of people will say, oh, I heard rents are definitely going down. And if you're in the apartment space in some markets, yes, that has been true. But we have not seen that across BTR and SFR as an asset class. So generally speaking, they are stable or increasing in all the submarkets that we're participating in. So this is accurate data based on what I've seen. And it does appear that the demand for that product is going to continue to be extremely high. Now, we've got projects that could have started in 23 and 24 and 25 were very difficult to fund. And 50-60% of those didn't happen. And so there is going to be a pretty significant gap in supply over the next couple of years. And so it does appear that will only boost that number. Maybe that levels out, say in 28 or 29 as we get some more product, maybe 27 as we get some product in place, stuff that's going to be financed by lower interest rates this year and next year. But I think that over the next few years, it's going to be a very good spot for those rents to remain stable and continue to increase.
Yeah, and I mean, it makes sense from a consumer standpoint. If you're looking at the cost to rent in multifamily an apartment versus looking to rent a single family, and the rents aren't that far apart, like where as far as like the price that you're going to pay for what you're going to get, it seems like most people have that dream still of wanting to own a home, and it's much closer to the feeling of owning a home when you're doing a single family rental versus an apartment rental. And so, I mean, it's not
huge.
Surprising. Yeah,
it's huge. Yes, you've got that American dream of having your white picket fence and having a four-wall dwelling that is yours and a garage that you can pull into. Like, there's just some certain things that the American psyche just really latches onto. And living in a large apartment complex doesn't check some of those boxes, right? It's a roof over your head, but it doesn't give you that feeling of independence that Americans value to such a great degree. And what they're saying with their pocketbooks is that we want that feeling of independence. Even if we can't have a dwelling that we own, we still want to have the same experience in a rented state. And the way the interest rates have been the last 2 years, in general, it was $1,000 or more a month cheaper to rent the same dwelling than it was to buy it. And so for that reason, we saw, a huge boom in this market sector. I think as interest rates come down, we'll definitely see people being able to make a more realistic choice of, okay, it's about the same cost to rent or about the same cost to buy. And many of those people will buy, but we still see a tremendous amount of people who do want to rent only because it just isn't practical for them or isn't desirable for them to have the responsibility of all the things that happen on the exterior of an owned dwelling. Whereas in a BTR subdivision, you're going to have somebody else handling all of these things. And so whether you're retiring or whether you've got a young family, you just don't want that burden. renting in some cases still is a more attractive option, even outside of the purely the cost issue.
Yeah, that's something I want to keep an eye on this year is basically if rates do start to come down, I'll be interested to see what impact that has on single family rentals
Right.
versus, the number of people who truly are going to go and get loans. And a lot of it will also depend on, what requirements are there for down payments, because even if the rate's a little bit lower, what does the down payment requirement look like? And
right. If you don't have the down payment, then it doesn't even matter. Like
yeah, exactly.
You have to go the route that requires no down payment.
Yes. And
sure.
just seeing the amount of debt that consumers in general are in, it just makes you wonder how many people truly have the funds to go make a down payment on a mortgage, even if rates were lower.
Right.
But we'll see that play out this year. We don't even know if rates truly, how much they will even come down in 2025. I mean, Trump's pushing for it, so we'll see if he's able to influence. But again, he would have to influence the Federal Reserve, and I don't know how that's going to all play out.
Yeah, indeed. I think it's a lot of rhetoric at this point, and how much actual ability to affect it. It's negligible, perhaps. So let's see how that plays out.
Yeah, exactly. Let's move on to the third and final headline here. This one comes to us from Market Watch. How a smaller government real estate footprint under Trump could boost cities. Efforts to shrink the federal government's sprawling real estate footprint that began in the Obama era have gained new urgency since President Donald Trump's inauguration. The incoming administration's focus on a smaller government could create ripple effects in communities far beyond Washington, D.C., since the U.S. owns and leases one of the world's largest property portfolios. But any new push by Trump's team to unload more of the government's real estate to private owners won't automatically spell doom and gloom for cities. It could actually help older office buildings establish their current worth, create opportunities for new owners or tenants, and benefit surrounding communities hit hard by the pandemic. Prices for office buildings in central business districts fell another 9.3% in December from a year before, according to MSCI's closely followed RCA Commercial Property Price Index. They were down almost 48% on a 3-year basis. Conversions of old office buildings can be difficult, expensive, and hard to pull off, but at the right price, they also can be a kind of triple win, as SL Green Realty Corp's chief executive put it Thursday during the Manhattan landlord's fourth quarter earnings call. Since conversions take obsolete office space off the market, chip away at the housing crisis, and help revitalize prime central business districts. The Wall Street Journal reported earlier this week that the Trump administration was considering selling 2/3 of the government's office properties, citing people familiar with the matter. It also indicated a large portion of the federal office leases in D.C. could be terminated. The White House didn't respond to a request for comment on its current real estate plans, but a deeper look at the government's office lease exposure and a timeline of its termination rights show that there's no immediate flood of broken leases swamping the market. The federal government reports its real estate holdings as consisting of about 8,100 owned and leased properties and some 500 historic buildings. Those properties reside in roughly 2,000 communities nationwide, including significant office exposure in Virginia, Texas, and Florida, locations that have benefited from a large and stable government footprint. In terms of office lease costs alone, the federal government currently pays $5.25 billion in annual rent, according to a new analysis from TREP. But with only slightly more than 5% of that space eligible to terminate its leases before the end of 2025, it makes any quick exits difficult. So what are your thoughts on this one, Charles?
Yeah, I think this is fascinating. The Office of Government Efficiency is going to be definitely looking at all these elements. I don't know that this is the quickest way to big chunks of dollars coming back, though. It just seems like a lot of these long-term contracts are going to be a little more challenging, and that'd be a bad look for the government to go start defaulting on long-term leases. So maybe there's a way to exit some of these, but I think they're going to have to be cautious in how they do that. I don't think there's any desire to go damage local real estate markets or have significant negative impact to the people that own these buildings that they're leasing. And you just think about how the money connects. Like, the people that own giant property portfolios that the government leases probably are big campaign donors. Like, nobody's going to step on those toes realistically. So I don't think this is a big one that they're going to go after. It's an element to consider, but I think there's way bigger chunks of dollars to go after as they're trying to shrink the government footprint overall.
Yeah, that was something I looked up really quick, before we were recording today was, what is the annual budget? How much money does the government actually spend? And it was, north of $6 trillion per year. And then you think about, 5% of the 5.25 billion is $262 million. So you're talking about potentially if they were to cancel 100% of leases up for renewal in 2025, that's $262 million out of a, $6 trillion plus budget. I mean, it's a fraction of a fraction of a fraction of percent of impact to that. So it doesn't mean they're not going to go after, any low hanging fruit that they can. So I do think there's going to be opportunities here as far as, some office space that may become available. But at the same time, I also think that, the Department of Government Efficiency is going to be looking at other quick wins where they're going to have a much bigger impact on that total dollar amount. I mean, I think the first steps that they took was they had canceled 2 leases, but they also canceled a bunch of contracts related to DEI initiatives. And so the DEI initiative cancellations was $420 million. So even that was like twice what they could save by canceling 100% of the leases. And so, yeah, I'm with you on that. I think that I think they will be going through and looking for opportunities to sell, properties and things of that nature. But I think it's going to be a slower process in the real estate space to get rid of some of those properties and leases, whereas they're going to probably focus a lot more attention in other spots in the government.
Well, if you think about the entities that have a footprint on these local levels, this is the post office, this is the Social Security Administration, like these are things that they're probably not going to be able to just delete. So this is going to be, there may be 50 entities that have a headquarters in DC and a big office building that may need to get something renegotiated because they're going to shrink those dramatically. But to retool the post office, I'm not saying it's not needed. It probably is, but that's a longer process, right? That's not going to be a quick thing. That's going to be they do need to add a bunch of efficiency to the Postal Service. I agree, but I think that's a multi-year deal that probably isn't the focus at the moment.
Yep. So with that said, that is the final headline for this particular episode. Any closing thoughts before we wrap up?
It's been really cool to see all of these things happening. Like, I'm just a big fan of action, right? Words in the political sphere are pretty useless. Like, you can't hardly believe anything anybody says, but actions are a big deal. And the actions that we've seen over the last week are pretty significant. And we're seeing people do what they said they were going to do. And I appreciate that. And it looks like largely the general tone is that it's going to be protecting the dollar, protecting Americans, and looking out for our best interest in a scenario that hasn't happened as much over the last number of years. And so it feels like we at least have somebody that's looking out for our country's best interest and, the interest of the traditional family and the interest of a lot of things that a lot of us value. So it's been a very fascinating week to watch these things happen. I think there's going to be plenty more of that over the next couple of weeks.
Yeah, there's definitely been a lot of action, and we know that it's going to keep going. So we will keep an eye on all this and be back in a couple weeks on the next industry news episode. We have a good interview that's going to be released next week. And I guess the last thing I'll say is, from what I said at the beginning of this episode, if you haven't left us a rating and review, please do so. I'll share an update in our next episode of kind of where we're at that point. But again, it goes a long way in helping us get this show in front of more people. So as always, thanks for tuning in, and we will talk to y'all next week.